The intensifying war between Israel and Hamas in the Middle East is raising concerns about the risk it poses to the global economy. A broader conflict could disrupt supply chains, raising the price of oil and worsening inflation here in the U.S. Joining me now to discuss the geopolitical fallout from the war is Yardeni Research President Ed Yardeni. Ed, thank you so much for joining us.
Thank you, Carlton.
So just taking a look at the market this week, there has not been much of a reaction to the war. And I'm just kind of curious to get your thoughts on why that is.
Well, over the past few years, there have been several crises in the Middle East between Israel and Hamas, Israel and Hezbollah up in the north. And those have turned out to be fairly short-lived crises. And were contained and managed in such a way that they came up with a ceasefire, and life went on, even though it could be pretty brutal. As a result of that, investors have come to conclude that these kind of flare-ups in the Middle East don't last very long and don't necessarily have much in the way of global macroeconomic consequences or much consequences for the U.S. Now, the markets may be wrong about that, but the fact that we haven't had really any sort of correction, any sort of significant sell-off in the stock market on fears of a global recession, nor in the bond market on fears that oil prices are going to spike up, suggests that investors are actually pretty relaxed about the situation, as horrible as it is.
Yeah, and when you talk about the reaction or perhaps non-reaction that we saw in oil markets, I'm just curious if there's anything that you are watching for that could change that.
Well, at this point, I think that the market perceives that the global supply of oil won't be disrupted very much at all by what's going on between Hamas and Israel. If this thing spreads and Hezbollah gets involved, and then in turn Iran enters the fray one way or the other, that would get very ugly very quickly, and the price of oil could certainly spike up. You know, what we saw in the summer is that oil prices went up. Saudi Arabia announced that they wanted to cut back their production by 1 million barrels per day, and that led to the price of oil going up over $90 a barrel. But then something interesting happened. As gasoline prices went up, U.S. consumers cut back on filling up their tanks, or they didn't drive as much. And as a result of that, we've seen some weakness in the price of oil. Recently, it's just been really moving with a lot of volatility sideways. I don't think we're going to see 100 to 120. I think that would be a scenario where it would be a spike in a considerably worsening Middle East situation.
And just want to turn over to bonds right now. Early in the week, we did see bond yields go down as a measure of safety. But we also had the week Treasury auction in the week as well. What is your outlook for bonds?
Well, you know, the bond yield for the 10 years back to where it was before the great financial crisis, 4.5% to 5% may be the level at which we can get enough investor interest, enough demand to meet the increased supply. Clearly, the auctions are kind of sloppy here, but we really didn't see the bond yield soar, or it soared for a little while, but then it come back down for the 30-year. But we're still in that 4.5% to 5% range, and so I think we may very well be at a level that equilibrates supply and demand.
And curious, what does that mean for the Fed raising rates?
Well, it's interesting. A few Fed officials have expressed the opinion that maybe the bond market's done some of the heavy lifting for them. I mean, I would estimate that the increase in the 10-year bond yield from about 4% to something like 4.5% to 5% recently is equivalent to at least a 25 basis point increase in the Fed funds rate, probably more like a 50 basis point increase in the Fed funds rate. So I don't think the Fed has to do any more, and I think those Fed officials will be persuasive at this next meeting at the end of October and beginning of November. And I don't expect the Fed to be raising the interest rate.
All right. Well, thank you so much, Ed Yardeni.